Hey, welcome back. It's Nolan Mathias from Mortgage 360, and we had a crazy news week. We had RBC and BMO calling for major changes to policy with respect to the real estate market. Then we had Tiff Macklem finally acknowledging that some of the things he's seeing in the real estate market are worrisome. And then ultimately we had TD come out and say, hold on, guys. This is TD, by the way, usually the most pessimistic bank and lender, in my opinion, when it comes to the market, at least going back to 2008 and 2009, saying, you know what, pump the brakes. Maybe we don't need to make any changes yet. And basically being the bank of reason. And what I want to talk about today is obviously those four news articles, but I also want to discuss what I would do if I was a first-time home buyer in the super hot markets of Ottawa and Toronto, not knowing necessarily what the future would hold. But before we get into it, do me that favor, hit that subscribe button, hit that notification bell, please hit that like button so more people like you can see this video. And don't forget about our race to 10,000 subscribers, where one lucky subscriber is going to win their monthly rent or mortgage payment for a month just for subscribing to this channel. Huge thank you to the 3,000 plus new subscribers in the last month. I appreciate each and every one of you. Thank you for hitting that subscribe button. If you haven't already, it's free, it's easy, it's definitely worth it. So go ahead and hit that subscribe button. The definitive guide on how to manage your credit. Product, penalty, price in that order. It's never been more important to get your mortgage right. Okay, so let's get into it and let's discuss all the news from this week because it was a really interesting news week in real estate. We had 3 of the 5 major banks introducing commentary into the market with respect to what they think should be happening to cool the real estate market. We had RBC, first of all, coming out on Monday and saying that some of the sacred cows of real estate should potentially be killed. Things like the capital gains tax exemption for properties that people buy and live in as personal residences. Then we had BMO come out and basically second what RBC had said, saying that perhaps that should be killed as a method of cooling the market. And then we had Tiff Macklem finally acknowledging that there's some overheating in the housing market and basically saying that people shouldn't necessarily believe that housing prices are going to continue to go up over and over and over again. And he's trying to basically quell those expectations of continually rising housing prices. And he's right. Chances are somewhere down the road, housing prices are going to come back down. The question is how much, and will they come back down to current levels? And then the interesting thing is we had TD CEO, the TD CEO come out and basically say, hold on, guys, pump the brakes. Maybe all these policy changes, maybe all these things we're talking about, it's a little bit premature. Now, if memory serves me correctly, TD was the one bank going back to 2008 that was always ultra conservative. They were always the ones pushing for government intervention, for changing the rules, for basically making it harder for people to borrow. And a lot of the lobbying they did successfully changed the rules within Canada and with respect to things like the stress test and with respect to different changes at CMHC and whatnot. But now we've got TD in 2021 becoming the voice of reason saying, hey guys, just a second, let's see what happens. Let's see how this plays out before we make any knee-jerk decisions. And I think that's interesting and an interesting conversation to have going into the first week of April, which is typically when the real estate market really starts to pick up. So I want to throw you into my screen here real quick and just show you a few things. This was the first article on Monday from RBC. Capital gains tax and sacred cows could offset hot housing. So basically providing a means of cooling the housing market to the federal government and saying, hey, we think this might be a good idea. Now, this was something that happened back in the 1970s in Ontario. It instantly cooled the market there. And it is something that has been used in the past to basically quell the market and make it so that a hot market that has really fast rising values basically cools off quickly. Now, interesting to note that the same issues we have today were the same issues that we had back in the 1970s with respect to everybody believing that the real estate market's too hot. Then we had BMO come out the very next day and basically second what RBC had said. And, they actually went so far as to introduce a report, which I've pulled up here for you. And they outlined several different methods that the bank or that the federal government or the Bank of Canada could help quell the real estate market. The first, and probably what will be the most controversial is the suggestion that the Bank of Canada should perhaps look at pulling back its guidance that interest rates will remain low till 2023 and should ultimately lower or start to increase interest rates sometime in the near future. Then they looked at the real estate bidding process and basically implementing blind bidding, which is an interesting conversation because a lot of jurisdictions, which are provincial, they forbid realtors and sellers from sharing the bids on a property with with other other potential buyers. And basically, what this would mean is that if two parties were to bid, they would be able to see what the other person is bidding and therefore make a more strategic offer and maybe not offer $30,000 over list price if the next highest bid is only $5,000 over list price. Now, I think there would be some interesting conversations around this. I know that um, the Alberta regulator, for example, in the past has been very adamant that a realtor who has a client who is a seller needs to do what's in the seller's best interest. Would it be in the seller's best interest to not necessarily disclose what the other offers are to the buyers so that they could see them all? So I think that's interesting, and I think it's one that would have to be dealt with on a provincial level because that's where real estate is regulated. But an interesting suggestion nonetheless. And then a speculation tax. I think this is the obvious one. There should almost certainly be some sort of speculation tax, not necessarily for Canadians, but for people who are coming in with foreign funds and trying to purchase properties in Canada. And they outlined broadly increase the capital gains inclusion rate on real estate. So that's what we've been talking about with respect to removing the capital gains exemptions on personally owned properties. Increase single detached supply. So this de-urbanization, after we've spent all these years urbanizing, de-urbanizing might be a method of cooling the housing market, which means spreading out, allowing more single family properties to be built over a larger area. I think that's obviously something that municipalities should definitely be looking at and provinces should be looking at in order to increase the housing supply. And it goes on and on and on and on. Tighten mortgage standards, further limit equity takeout. I mean, they've created quite a massive amount of suggestions here, all of which I think the government will consider, but none of which I necessarily think are going to have major effects short term, or that may not have the opposite effect, which is if they introduce new regulations, it could spur on further buying and further selling and basically heat the market back up even further. So, BMO came out, interesting conversations, and then TD comes out, and this is the best part because I love this. Bharat Masrani, the CEO of Toronto Dominion Bank, basically came out and said, hold on, guys, pump the brakes on this. We actually need to see what's happening before we start going out and saying, let's make a whole bunch of changes. And I think this is probably the best thought process with respect to all three, RBC, BMO, and TD, commenting on the real estate market this week. Because what you've got is two economists going, hold on, we need to cool the market. And then you've got the CEO of one of the major banks saying, just wait a second, maybe we should just see where this goes. And I think to paraphrase what he's saying here is preferences are changing. And I've reiterated this in other videos. I've said preferences are changing. People, are looking to buy different types of houses. They're looking for different things. And we need to consider the fact that those preferences are partially what's driving the market along with low interest rates. And if those preferences start to shift, and they will shift, because when people see how cheap condos are in the downtown markets, they're going to go, why am I paying all this money for this big house that I thought I wanted? And they're going to start moving back to the downtown markets, and that preference will shift again, and the downtown condo markets will start to come back out, and the outside markets will cool. It's just the natural way that markets run. And that's what we need to consider, is just letting this market run out, knowing that the lower interest rates and the preference changes are what's driving it. But let's just see where that goes before we start making knee-jerk policy decisions. Now, I promised you at the beginning of this video that I would talk about what I think somebody should do if they were in one of the hot housing markets and they were new to the market, they were a first-time home buyer. Because this is a question that I've had quite a bit on in the comment section of different videos, is what would you do if you were in the Ottawa or the Toronto market and you needed to buy a home? And people are citing the fact that the average home in those markets is $600,000 or $700,000 or $1 million. And the key thing to remember here is just because the average housing price is that high, it doesn't mean you have to buy the average house. And if you're a first-time home buyer, your expectation shouldn't be to buy the average house. Your expectation should be to be buying something that is entry level. And if I was worried about getting into the market, if I was worried about whether or not I'd be priced out of the market in the long run, here's what I would be doing. I would probably be thinking about, recalibrating my expectations of where I should live. And I would start to look for more affordable properties that in the long term are going to be good rental properties, because this is something else that came out in the news this week, is that real estate investors are purchasing condos at a deal in downtown Toronto with low interest rates. They're taking negative returns on them, and they're doing so because they expect down the road that the returns are going to become positive. And what that tells us is that there's deals in the downtown markets, the urban markets, the entry level real estate markets, and that investors are expecting that somewhere down the road, those properties are going to make good rentals. So if I was looking to get into the market and the house I desired was priced out of my price range, what I would be looking at is maybe not buying that house that I desire today, but maybe buying something that's a little bit lower end, maybe something that's a little bit smaller, and then holding that property for the next year or two, and or 3 or 4, and living in it. And when the market comes to a place where maybe it's cooled off or the rents have come up, or maybe the market's gone up a bunch and I've gained some equity because I've bought that property today and held on to it for a couple of years and I've paid down the mortgage. Well, then that gives me the equity to eventually buy the house that I actually desire and that I want to live in. And it also gives me the ability to keep the property that I bought and rent it out so that I have another property that's building me wealth over time. And, when I go back and I look at 2006, 2007, we had a lot of clients back then that bought condos as first-time home buyers. And in 2010, 2012, 2015, when they came to us and said, hey, we want to buy a house now, we said, whatever you do, don't sell that condo, because they're almost paid off. They've gone up pretty significantly in value. And ultimately, they made really great rental properties. And the one thing that we've noticed is that those people that bought those condos and ended up renting them out, and bought those townhouses and ended up renting them out when they could finally afford to get the house that they actually wanted. Well, those are the people that are on the fastest track to actually paying off their mortgage, because what they're able to do is they're able to use the free cash flow that they now have from those properties they bought in 2006, the last time the market was really, really hot. And they're using that to help pay down their existing mortgage. And they're also paying down the mortgage on that original rental property, which at this point, has basically 10 years left and is within really close reach of being completely paid off. So, if I was in one of those hot markets and I was worried about being priced to the market, what I would be doing is I'd be making sure that I get into the market. I might be buying for a lot less than the house that I really want to live in, but I'd be buying it so that I can gain equity as the prices go up. And if they don't go up, well, I'll continue to save for my down payment. And if prices come down, I'll still buy the house that I eventually want 2 or 3 years down the road. But regardless of if the housing prices go up or whether they stay the same, the fact that I'm in the market is what's going to allow me to ultimately get to where I want to go. So rather than saying, hey, I can't afford what I want, I can't afford the average price, I can't afford those properties that are way too expensive for me right now, you're saying, okay, I understand that I can't buy the BMW right now, so I'm going to drive the Civic for the next couple of years. And then when I can afford the BMW, that's when I'll head to that BMW dealership and buy that more expensive vehicle, or in this case, a more expensive house. So if you found this video useful, if you found it interesting, do me that favor, hit that subscribe button, hit that notification bell. Please hit that like button so more people like you can see this video. Don't forget about a race to 10,000 subscribers, and we'll see you on the very next one. Cheers.